Good afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined by Mr. Andree Stracke, the Chief Commercial Officer of RWE Supply and Trading. Andree, welcome to the show.
Thank you very much for having me.
Pleasure. Andree, it's certainly been a spectacular period of time on so many levels, that goes without saying, with the COVID pandemic. But for LNG as well, we saw record prices in the early part of the year, with prices spiking nearly up to $40 per MBTU on the JKM into Asia. So some spectacular moments. How has COVID-19, would you say, in general, impacted the natural gas industry?
Yeah, as you said, just recently we have seen these record prices on JKM. That was driven by a few incidents which happened at the same time. On COVID as well, we have seen last year and record low prices as well. So we have got a massive volatility in the LNG market and in the gas market as well, which shows that markets work to that extent.
Would you say those two things are related, i.e. the record low prices, or prices were very low for a while and then they spiked very high because perhaps consumers never took advantage of when prices were low? They just presumed they'd be low forever.
So is there a direct link between these two incidents? The answer is no. Because the special thing in summer actually was that there was a significant demand drop due to COVID. First in Asia in the first quarter, and then in the second quarter in Europe, and combined with high temperatures and low demand for the heating sector, it created a very low demand. In Europe, we had a 6% drop of gas demand due to temperature, but as well due to lower power demand. Therefore, we have had less demand on gas-fired power stations. We've had a lot of renewable wind impact as well that created a very low gas demand in Europe, and therefore it's kind of a price-setting instrument as well for the world markets, because for me, Europe is a kind of an flexibility demand service for the rest of the LNG world. Then, of course, the US reacted to that one as well with cancellation of cargoes. And then the event this winter was totally different. The opposite, right? We have had very high, very cold weather, especially in China and Japan, South Korea. So the strong demand, and there were not sufficient ships available at that point of time as well, which increased the gap and the availability in very short notice pushed these prices up. Though most of the physical cargoes were traded far below the numbers we have said earlier.
Right, of course. Yeah, they were just temporary, momentary spikes. But in terms of how COVID pandemic may have impacted LNG and the gas markets, how would you see that?
For me, it was a very good sign that the LNG market developed significant forward with regard to a traded market. With these, as I said earlier, with these very low prices, we have had, I think, 160, 170 cargo being canceled in the US, because the US has got the opportunity to utilize this gas alternatively in the US market. And economics showed that this was not economic at that time to produce LNG, which is a very nice new tool in the LNG world, actually, to balance the LNG market. And it shows as well that FOB cargoes being available in the US have the flexibility to go everywhere in the world. And then with regard to these high prices, I think the Panama Channel had a huge impact as well, as not sufficient LNG ships could pass in due time and had to take a longer route, which absorbed a lot of shipping capacities again. But all of these tools show that the liquidity in the LNG market is much better, and it is easier to source cargoes. It is easier to push them somewhere else, and therefore, for me, we are coming closer and closer to an oil world where oil is produced and will find a way into a market. The question is just at what price.
One of the big, there are a number of things that came through the COVID pandemic, and of course, we're still very much living it, as you are in Germany, still in different degrees of lockdown. But one of the things that was accelerated to the forefront, again, trends that pre-existed COVID, was the transition to the green economy, the transition to a more carbon neutral fuel mix. How do you think gas and LNG has performed in that conversation? It looks, in some sense, it might be getting hit a little bit. In other, it's the transition fuel for a lower carbon economy. How do you think gas has fared in this moment when the green transition has become very much more pronounced?
So you don't use the word competition, because sometimes I hear the word competition as well. I do not see that there's a competition between renewables and gas. For me, it's a complementary fuel, actually. And gas is absolutely necessary in the next 10 to 20 years to play tandem with renewables. I don't know if your viewers actually know these numbers, but in Germany, which everybody knows is a highly industrialized country, last year we have used 35 or 40% of the power demand in Germany was renewable power. In the UK, very similar. We see a huge increase of renewable.
But 40% was coal, probably.
No, it's less coal in the meantime.
Is it less? Maybe 30 something then.
Yeah, it's still some nuclear, and the majority is now gas. The gas-fired power plants are running more or less base load in these days. That's of course driven by gas prices as well.
But for example, during the crisis, we had the emergency fund out of the European Union, a large chunk of which has been designated for the transition to be deployed for transition projects, and it has excluded gas from those consideration. Is that not an indication that gas could be excluded from the transition fuel mix?
The European Union is pushing towards hydrogen, and actually for the European Union, it's clear that renewable energy will take the lead on the power supply. As RWE, actually, we have now invested 9 gigawatt of our installed capacities. We will increase it in the next years to 13 gigawatts, and we have got a pipeline to install new of 34 gigawatts of renewable energies, and that's true for Europe, wow. True for the US mainly as well, but for the Asian markets as well. I think for me that's a given. The question is, what is next in order to give an alternative to gas, and that will be hydrogen. So therefore, we have developed a massive step into hydrogen as RWE as well. We have got 30 projects in Europe right now on hydrogen, and this was the stimulus from the EU. It's towards hydrogen, and that will not play a role tomorrow, but step by step, hydrogen will roll into the mix, and therefore.
How will that impact? I mean, Europe has been the center, if you like, of the gas world for many decades. LNG increasingly a very significant part of the mix there. Will this refocus by the European Union change gas? Will it shift gas towards Asia? Does it impact the desire for or the need for Europe to build any more LNG plants?
RWE is just building, by the way, a gas plant in Europe, and that is.
Can you move it?
It's a project. We are building it because we need capacities in order to balance off the non-stable supply from the renewable side. We need to balance off with gas, so we need more gas capacity to balance the power grids, because a power outage is a non-acceptable thing in Germany whatsoever. So we need the power, and no power is no alternative. So we need we need very quick step-ins to stabilize the grids. And so the grids asking for capacities, we are offering it in a kind of capacity markets where we are actually obligated to supply on short notice. The gas-fired plants, step by step, coming more into base load power anyways, the existing ones. So we believe that there is the gas power need for the next 10 to 20 years to come, to be honest. So that is
Uniper recently,
nuclear and we are phasing out of coal. So we need some base load opportunities.
Uniper recently struggled to launch an LNG project at Zeebrugge. The financing and the market didn't seem to support another LNG plant. What does that tell us about this wider story in Europe?
Yeah, I think there was a project in Wilhelmshaven in Germany, where the demand was not high enough. I think we are supporting a project in Brunsbüttel in Germany, that's close to Hamburg, where an investor, a capacity investor, is actually building it, and we are an anchor customer with huge volumes, and there's one other big customer who has capacity rights, and we want to build it. I believe that we need additional capacities in Europe, and the background is not the volumes of LNG which we really need, but it's a flexibility behind it as well. I think if you see the Netherlands is significantly reducing production. The UK has got by far less volumes produced than in the past, and they will not increase it significant. Germany is going down from 20 BCM to, I think, 5 today, and will go down to 0 as well. It's only Norway which is stable, and Russia. And the question is, what is the political flows? What is really necessary? We believe that over time, the gas demand will go down, and that is mainly from the retail and heating sector. At the same time, we have got by far less production in Europe, that we need additional volumes for Europe until 2030, 2040 in order to balance the systems.
On that point, Nord Stream 2, very famous now for it being a sort of controversial second pipeline from Russia. The Americans are obviously not happy with it. From a purely market point of view, does Europe need that gas?
The gas is flowing today via other channels as well. Is that pipeline necessary? I think we are a trading house mainly. We do not have assets, and we do have no stake in Nord Stream, neither 1 nor 2.
Yeah.
I think it is every investment in assets, if it is pipelines or storages, and it's paid privately or by someone, is good for the market in order to stabilize and to have a more flexible system behind it. I think that's a neutral answer to that.
Yeah. No,
it's the same thing, right? I think someone need to pay for it, and it's good to have it. The question is to what extent it is utilized and who is paying for it. These are the key questions.
And the flexibility, obviously, it brings, gives, you would think, in the overall holistic sense, more competitiveness in the market, better pricing.
And more flexibility from the system to react. If you see last year, when prices have been very low and before cargoes have been canceled in the US, lots of these US volumes were flowing to Europe. And Europe is actually, I don't want to call it a sink, but it's a sink, right? So it's, with all the flexibility in the European system, Europe participated from the worldwide demand supply situation and received by far more LNG cargoes across the European LNG terminals. There was a usage of 80–90% of some of the terminals. And therefore it's good to have them. That was because prices were low and there was an optimization opportunity. But at the same time, it was be good as well to have these flexibilities in order to overcome supply shortages from other areas. So
you said earlier about gas not being a competitor for renewables, but ultimately, as the pricing structure, as the pricing of the cost of renewable to power, solar to power, wind to power becomes so competitive, gas, like anything else, has to compete with that price point. is gas over you said 10, 15 years, it might start to be in a decline position, but can it compete with the cost decline of renewables?
In the long run, it can't. In the long run, because the marginal price, the marginal costs to produce renewable is zero. Once a windmill is installed, it is there, the wind blows. And the same is true for solar panels with low margin or with marginal cost of around zero. I think LNG has got the opportunity as well with very high investment costs, but thereafter the marginal cost to produce LNG is relatively low as well. If you're a producer with no alternative to put the gas somewhere, it's even sunk, and the costs you are having there as well. So you're close to zero as well. But in the long run, to compete with renewables, which has got a marginal cost of zero, it's not really possible. But then we are 20 years further ahead, and then the world will look different.
In looking more imminently, more immediately, we have, Andree, I'd like to just touch on the US as a gas exporting market. What's your outlook for US gas exports as we move out of the COVID pandemic? How do you see that developing, and where is its natural market?
I think overall it's positive for the US because the gas which is produced in addition in the US is mainly coming out of shale oil, and it's a byproduct. Therefore, the gas is there. The shale opportunities are still pretty good in the US on the oil side. Therefore, gas will come, and the margin, and at some point then the marginal costs are low as well. But as well, Henry Hub is a benchmark, and then it depends on the overall price level of commodities worldwide. And on the price level we're having today, US projects are profitable, even on the long run. So if you would keep the commodity level on this price, the US is competitive. I think we will see in Sabine Train 6, Venture Global, and I think Golden Pass in 2025, 2026 will come in. The question is then, what are the new projects? I think you've had Sharif here with Tellurian and other projects. Yeah, there is an opportunity.
Do you think the natural market is for Europe for US LNG exports or to Asia?
I believe the target is Asia at the end of the day, because the growth, the real demand growth of LNG or gas is Asia.
But the problem in Asia is, isn't it? That, I mean, the infrastructure, besides the mature markets of Japan and Korea, Bangladesh, Pakistan, struggling to build and invest in the infrastructure costs.
But you have got these projects on floating regas, which obviously helped a lot in the past, right? Look at Pakistan or Bangladesh, and maybe there are other countries like Vietnam, Philippines, whatever to come as well. So that takes 6 months to build the infrastructure to connect these markets if prices are preferable. For me, coming one step back to the US, it's a pricing question. So far, the negotiations the European companies had, and lots of Europeans actually signed in to long-term offtake contracts. It's Henry Hub indexed. Henry Hub indexed LNG is a different thing than what we are having in Europe, which is NBP or TTF indexed gas. So it's a different pricing signal. And if you buy it, you take a long-term price risk over Henry Hub, which is difficult to absorb for like us in a medium-sized company, despite the fact of a huge utility. But
should US exports price structure change then? Should it be oil index? Should it be?
Oil index would be potentially easier. Ideally, it's a net back. It's either JKM, right, or for the Asian market, or a TTF indexed. But then you change from the price risk back to the producers, and then the question is, are they willing to take JKM or price risks in Europe? But if you see an oil producer, which massive investments into oil fields, they invest, they know the oil will go somewhere, and they take the price risks. So the question is, are US producers in the future not capable to do the same with risk appetite on the investor side to produce LNG and not having necessary 15 or 20-year offtake agreements in place? Because I'm a strong believer that the market is so liquid in the meantime that you can, every cargo you're producing, you can sell it. The question is just at what price? And that's the opportunity the US markets have, because if you can't produce LNG, you can still sell the gas in the US instead.
In the Asian market, in order for it to be developed, obviously the growth, the demand is clear, but the infrastructure is not. I just come back to that point. Liv, you talked earlier about the efficiency of the European market, all of the options. It's the I think you called it the sink of the global gas market. The Asia being the demand center. What is your thoughts on the outlook of what the infrastructure it needs in order for it to continue to mature? It has no storage of any note. It has very limited built infrastructure. Yes, floating, but not established LNG infrastructure. How much of an obstacle is that, do you think, for the growth of the LNG and the gas markets in Asia?
I partly opponent, right? Like look at China. How many LNG terminals have they built? That is a lot of infrastructure, and it's the same situation the Chinese have as well. They need storages, and as they don't have sufficient underground storage, they need, especially for the winter demand, they need more LNG storages. And I'm pretty sure that China, so various companies, will invest into additional infrastructure, and that is land-based tanks in order to absorb more LNG. Japan obviously do not need these additional facilities, but all the new demand centers, like we have talked about Bangladesh and Pakistan and others, they have the opportunity, from my point of view, to utilize regas units, and then they can utilize pretty quick additional demand, and then it can be replaced step by step with land-based LNG terminals as well. Of course,
is there an opportunity for more pipeline in Asia? I mean, where you might have LNG import locations, and then there's much greater pipeline grids working off of that.
But you've got very long ways to travel with that gas. I think China has got contracts with Russia and with Kazakhstan and so on as well, but you have got thousands of kilometers to transport the gas as well. And then you arrive in regions in China where the demand is not really there. So you need to transport it all the way to coastal areas with the high demand centers.
I mean, these two things seem to be happening at the same time, in a way that the pricing structure of the market is changing towards spot and towards the JKM in Asia and the other, while at the same token, the flexibility of the purchaser that doesn't want to commit to 20-year contracts, and so the architecture that paid for the last generation of infrastructure is not there anymore. How do those two, so how do you square that circle, if you like? Spot market, but nobody's there to pay for the infrastructure.
So you need to believe in the demand increase. I just have to laugh, because if you look in Germany, the transition into the renewable, and so the energy transition into renewable only works because we have invested in the past in power plants as well, conventional power plants, coal and gas. And so the question is, we can't utilize them as long as we have expected. So you need a higher return, of course, as an investor in the early years in order to make up with the investment risk. On the gas side, it's a willingness of the buyers later to pay for the gas. I think every investor who is doing it early has got, of course, a market access, which is then difficult for the others to catch up later. So there is an advantage to be early in and to put some money on the table for investments in assets in order to participate then in the future access to these markets.
We just finish up, Andree, in the Middle East where we're sitting. There's been a lot of development, a lot of change in this market over recent years. Clearly, a region that has always been a gas exporting region, but now increasingly becoming one where gas is being imported and a very critical fuel for power generation. How do you see that shift? How could it possibly, how will it impact the global markets?
Yeah, it's a definition of the Middle East and these countries where you are importing additional gas. I've worked for Accelerate Energy in the past, and I think in 2009 or 10, we have established in Kuwait the first LNG receiving terminal, which was a floating terminal at that time as well. I think the demand today is 5 billion cubic meter a year in Kuwait, roughly.
And they're now building an LNG onshore facility, regasification facility.
This is what I said earlier. You start with the quick solutions and replace them step by step if it works with other kind of infrastructure. I think Egypt was a specific case with 2 export terminals. Then they've imported at some point via 2 floating regas terminals, and now they're an exporter again of I think 5 million tons. And then you've got Bahrain and the Emirates importing more gas and other countries as well. At the same time, you've got Qatar with a massive investment to be done in the next years in order to increase capacities, I think from 78 million tons to 112 or so. So net, if you see that, because for me, it's a cargo produced in Qatar, and maybe Kuwait or Bahrain taking other LNG from somewhere else in the world, but it's still a cargo, right? So it's
it's a region begging for pipeline. I mean, we have one pipeline connecting Qatar to the UAE with the Dolphin gas pipeline, but clearly we need a lot more gas to move on pipe across the region rather than everybody building their own LNG facilities.
But look at Saudi Arabia. To my understanding, they want to import gas as well. And then
well, they're still burning 1 million barrels of oil a day in the summer for power.
It's environmentally it would be better to burn gas, or even better, they are starting to do more on the renewable side. And I think the renewable part is it will be the renewable solar solutions and maybe hydrogen solutions will be utilized in Saudi Arabia. But again, it needs to be a combination with gas as well, at least for the next 2 decades. And therefore, gas demand is there, but there's more LNG to come from Qatar. There are other projects in Nigeria, in Mozambique, in the US, in Australia.
I mean, in our region, just to stay here for a second, that we have over the decades become very attached to oil indexed pricing over long-term contracts. Are we going to have to get used to things completely different for the gas exporters from the Gulf? The market that they're going to have to adapt to is spot and short term.
Yes.
Yes.
Because that happened on oil as well, right? I think the same is true. I think all the producers in your region are happy to take the risk on Brent pricing and WTI pricing and Arabian Light and whatever products you're having as well. But it will go step by step only. We still see oil indexed contracts on the LNG side. It's still a good benchmark. And earlier I talked about the level of commodities. There's no coincidence that if oil prices are high, LNG prices are high as well. So it is maybe for months or 2, you see big gaps between these various commodities, but we have seen over the past that this levels out, and we have not seen situations where only oil was high and LNG was low all the time. So these things catch up, and it's not substitute, but you can replace oil with gas in the medium run and vice versa, and with other products as well. So I do believe that we come into shorter term durations of contracts. That's something what we observe already. It's maybe not the 20-year contract any longer, but now it's only 10, and then it will be 5. But we are seeing actually that what we call the traded LNG market is now, I think 30-40%. We are on short-term contracts, and the definition is up to 3 years. So the trend is clear, and the trend is non-stoppable.
Yes, and it also involves, very importantly, no destination restrictions. And that, of course, is another big challenge. Andree, we could talk all day. It's really enjoyable. And I really thank you, Andree Stracke, Chief Commercial Officer, Origination and Gas Supply at RWE Supply and Trading. Thank you for joining us on Halftime Talk this week.
Thank you very much for having me, Sean. All the best to the region. All the best.
Thank you. Thank you.